if you're just buying one-offs, the closer, the better. You don't want to drive across town. You don't want to have your maintenance people drive across town. That just costs money. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, as always on these Wednesdays, we got Matt Jones. Matt, how are you doing today?
I'm doing good. How about you, Todd?
Doing well. Man, just another day in paradise. That's all.
Yes, indeed. I think spring is finally here for Minnesota.
Really? It's freaking cold out today, Matt. It's like 25 degrees, I swear. I was just outside and almost got lifted away by the wind. So I don't know about you, but spring is not here for me.
Well, but by the time this episode releases, it's supposed to be in the 70s.
Oh, well, there you go. There you go. Well, cool. Matt, we're gonna do something. Maybe I guess we've done things like this before, but we're gonna start a series. So why don't you tell our listeners what we're gonna be doing?
Yeah, we're going to have a series of different episodes where we talk about different asset classes.
Yeah, so we'll dive in to the various asset classes. We probably won't be able to cover all of them because there's a lot of stuff out there, but we'll dive in kind of all the major food groups, at least in real estate. And maybe we'll even dive into stuff that has a real estate kind of feel or has some real estate involved, but is definitely more of a business as well. So, but we're going to start from the basics. So what are we going to hit on today?
Well, we're going to be talking about 1 to 4 units. So single family, duplexes, triplexes, and quads.
Yeah. So any listener, if you ever hear me talk about single families, I'm usually talking about anything that's 1 to 4 family house. And I know the technical term for a single family means a single family, right? A single family lives there, one person or one household lives there. That's technically a single family. But I usually, when I'm talking about multifamily, I'm talking about larger buildings. And a lot of people, when they talk multifamily, they're actually talking about like a 4-unit building or a duplex. And in my opinion, it's not. I mean, technically it is a multifamily, but in my opinion, that's not really multifamily. It falls more into that single family realm. So why are we covering 1 to 4 family as like the same? For me, they have a lot of similarities. They have the same lending practices on them. So a single family home all the way through a fourplex, you can get the same loan or very similar loan. And, it's still small property, even though the one has multiple tenants.
Yeah, it's certainly easier to get a loan for a residential property in a 1 to 4 unit than a commercial, which would be 5 to or more units or a different kind of commercial type of property.
Yeah, and that's the big difference, right? So a residential property, and you said it just right, a residential property is 1 to 4 units. A commercial property is over 4 units, so 5 or more. And so if you're going to do a commercial multifamily, the technical term would be a commercial multifamily, it's 5 units or larger, you're no longer going to qualify with a loan that is in your personal name, Fannie, Freddie, you live there type of loan. You're not going to get those types of loans. You're going to have to go through like a commercial bank. You can even get agency debt if it's a big enough price, but you're going to have to go through a more of a commercial bank and get a different type of loan.
Yep. And especially if you move into the property and house hack it, then it's even easier. Often it's a lower down payment, a little better terms, that sort of thing.
Yeah. Yeah. So let's talk about this asset class. So single family, 1 to 4 unit properties, what we're talking about. And easiest thing in my opinion to get into because it's natural. Most people end up buying a house to live in, and so you can get into it both purposefully and accidentally. Some people become accidental landlords where they buy a house, maybe they go through a divorce, maybe they end up getting married, so they bought it when they were a bachelor, they get married, whatever it might be, or they take a new job in a different location, whatever it is. They buy a 2-bedroom house. It's them and their spouse, and they buy a 2-bedroom house, and all of a sudden they have 3 kids and 6 dogs. And they're like, well, can't live here anymore. We gotta upgrade, what are we gonna do with this house? Let's just rent it. So all of a sudden they become this accidental landlord. That wasn't their intention, but they became one. So that's definitely a way a lot of people get into it, and other people are much more purposeful. They're like, hey, I want to buy this single family or small multifamily. I want to buy these properties and start, building a portfolio.
Yeah, and I think for a lot of people when they're starting to invest, the idea of like what can I afford to get, and that's usually a 1 to 4 unit place. So that seems the most
Yeah.
achievable, the easiest bite to take out versus jumping in like, oh, my first property is going to be 100 units.
Yeah. Yeah. And I think it's even, also just familiar too. So you're right. Financially makes a lot more sense, right? Hey, I can afford to buy this, single family duplex, 4 unit, whatever. But also it's comfortable because it's a single family or a duplex or whatever. I lived in one of those. I've rented one of those. Like I know what's going on. You could go buy a single, or small commercial building as well, and you could probably spend the same amount of money, have the same similar down payment, but you're not likely as comfortable with that because, unless unless your mom or dad or aunt or uncle own something like that, or just like you're just not as familiar with that. It's something most people aren't as comfortable with. So I think it's just easy. It feels good. um Man, there's so much information out there about it, so it's easy to get into those deals.
Yeah, there's a lot of books, a lot of podcasts, a lot of blogs online. Just yeah, you're right. A lot of information is available for those 1 to 4 units.
The other thing is there's multiple strategies, and I think that's really kind of cool, right? So you can rent long term and get your traditional, tenant in there. They're going to pay you, you set them up on a year lease, and that's all good. You can also potentially get a more of a corporate renter in there where they're renting your place, and people might live there for a month and move out, and a corporation might even just sign a 1, 2, 3 year lease on it, 5 year lease on it. And they're paying you a set amount, but they're moving people in and out. As they get a new employee, that's, typically it's going to be a, higher end house, maybe have a higher paid employee, and they're going to move the family in there for a couple months while they settle in and find their own house to buy. And so the corporate's going to potentially have all the furniture there for them, or you're providing the furniture, but they're going to pay you a rate, and they might lease that long term. They might also lease it short term. There's also short term placements, and so you might be going to several different corporations, or there's companies out there that specialize in just getting these corporate rentals. You also have, of course, short term rentals where you can rent it by the night, by the week, by the month. So there's those old short-term rentals too. That's really popular with single families, duplexes, quads. Um, you can also rent it to various other groups. Mine is kind of a corporate rental, I guess. I've got one that is a triplex, and we rent one of the units out to the NHL, and they bring in refs that are going through training essentially, and they stay there. So that's really more of a corporate type rental. We sign a 2 year lease with them, and these younger guys stay there for 9 months, and then 3 months out of the year nobody stays there. They actually just pay for it because they know they need it. But there's also, you can rent it to other companies. There's companies out there that run adult daycares. There's companies out there that run kid daycares. There's companies out there that run senior housing. And so you can do kind of a master, or you can do a lease with them as well. So
Yeah, group
lots of
homes.
different
Yep.
options. What's that?
Group homes as well, and then
Group homes.
traveling nurses for like month-long leases.
Yep. Yep. So I think it provides you a lot of flexibility. Of course, the long-term rental is going to be your most traditional and easiest to probably do, but the rest of them, there's so much options out there. And I think that's A big advantage of a single family, small multifamily is that you have a lot of options.
Yeah, that's true. Usually, if you have an apartment complex, you're probably not going to do too much like Airbnb, for example.
Well, and the lender is going to restrict it in a lot
Mm,
of times.
mhm.
Like you can only do a small amount. Can be that short-term rental, corporate rental, that type of thing. So lenders oftentimes in larger multifamilies restrict it. The other big advantage of single family, especially, is that your residents typically stay for a long time. I mean, I've had residents stay for 8 years and longer, and take care of the place. Sometimes you get residents that want to buy it from you. We have not sold the property to anybody who's been our resident, but we've had several of them that would like to buy it, and they talk about buying it, and it hasn't worked out yet. But um, they care about the house. We had one resident that they lived there for probably about 7, 8 years. Can't remember. Look at the lease. But they really loved the place. They were looking at buying it, and actually, the riots in Minneapolis were the death of that.
Mm.
They no longer wanted to live in Minneapolis. They wanted to get out because of that. They thought it was getting to be a dangerous city. And so they said, forget it, we're out. And they moved out to the suburbs. But they put a lot of money into it. They put granite countertops in for me. They did a lot of work to the backyard, the deck. They did some other remodel and stuff that was really nice. And they always got approval. Hey, can we put in these granite countertops? If you really want to, you can't take them out though once you put them in. So it's pride of ownership. I think a lot of times, not always, but a lot of times, pride of ownership that you get with these single family homes that you really don't get with apartment buildings, not nearly as much.
Yeah, exactly. With single family, they tend to do, extra maintenance like lawn care or snow removal or, other things. Whereas like duplexes or more people, your residents tend not to do that.
Yeah. So good point, Matt. So all of our single family homes, our residents take care of the lawn, they take care of the snow, they're supposed to take care of the landscaping, all of that. That's their responsibility. And if we get fined from the city, that fine goes directly to them. They pay the water, they pay the sewer, pay the garbage, they pay the electric, they pay the gas, they pay all the utilities. It's essentially their house. They're paying for everything. They're doing everything. Now they aren't doing the major maintenance, right? But we do teach them how to do minor maintenance. We do show them, you know, certain things to change out this furnace filter. Here's the shutoff valves, right? Here's how you change the battery in the thermostat, things like that. Now we can't necessarily count on them. So we do have maintenance guys that run through the properties on a consistent basis, but a lot of the residents, or a lot of times when the maintenance guy goes through, the furnace filter's been changed. Um, things have been fixed. So the residents take care of it,
Yep. Yeah, that's when you have the long-term tenant in there anyway, versus the
especially
short-term. Yeah.
that. Yeah. Yeah. Um, obviously a big downfall, Matt, is that we don't have scale, or it's difficult to scale, right? Scaling is possible. Blackstone and some of those like the Invitation Homes and things, they have a lot of houses. It's funny because I was just talking with another person about this, and it's like, hey, most people that they move up to multifamily or move over to commercial, and they no longer want to do anything with single family duplexes, stuff like that. But at the same time, we were laughing and saying, well, but then you've got these big companies like Blackstone, coming in and buying swaths of single family. And I don't think they're embarrassed about buying their single family homes. In fact, I think they're pretty happy about what they did there. And so I think, a lot of kind of smaller players, by smaller, I mean, companies that have 10,000 units and less, they're sitting here going, well, we got to get out of single family homes. And then these other big players that have billions and billions of real estate, they're like, hey, we got to get into single family homes. And so I don't think you necessarily need to like consider single family homes this like first step. It can be a food group that you're participating in.
Yeah, and also I would say for a benefit, it's easy to sell them, quick to sell them because there's a lot of other buyers out there. At the same time, that makes it tricky with buying because then you got a lot of competition.
Well, so let's talk about the market for single family homes. Where the market for single family homes, I think, is an advantage and a disadvantage both at the same time. So here's the disadvantage. If the economy's bad and people are tight and afraid of spending, typically single family homes go down in value. Okay. Um, that sucks. But if the economy's good and people are wanting to buy homes, they go up, and it's an emotional buy. They don't go up based on the financials. So they don't go up based on, and even a duplex and triplex and 4 unit. Now, as you get bigger, like the triplex and 4 unit, it's going to be more financial. The duplex, not really much financial. And the single family, zero financial, right? So, Matt, I got this beautiful house in, in a nice location, and I bought it for, let's call it $150,000, and the rent is $1,800 a month, and I'm doing well. I like this property; it's cash flowing really good. But all of a sudden, the market starts to go up like it did in 2021, 2022. And I'm like, hey, this house that I bought for 150 is now worth 350. It's not worth 350 because my rent went up from 1,800 to 2,000, right? That's not why it's worth it. It's worth that amount, 350, 450, 500, whatever it is. It's worth that amount because of the emotional roller coaster that people get on. And I can go ahead and sell that for a ton of money. Now, at the same time, a 2008 happens, right? And all of a sudden, things come crashing down in that house that I own that, I bought for 150, maybe it went up to 350, is now only worth, 110. And I'm like, crap, I lost all my equity. Now, where it doesn't matter is if you're smart and you're basing your investment and your leverage on cash flow, who cares? Who cares that it went down in value? Because just wait until it goes up in value. So that's the beauty of, in my opinion, I really like that it's based on emotions, because it means I'm not tied to my performance. I'm not tied to the rental market. I'm not tied to how much my residents are willing to pay. I'm just tied to the emotional roller coaster that the economy has. And so I just need to wait till a really robust time to sell. And if I'm cash flowing, I don't really care.
As long as it's in a desirable location, then you can really ride the upswing.
Yeah, I mean, like anything, right? Location is important in real estate, and I think all these asset classes that we'll talk about, location is a big thing. But yeah, for sure, location's huge. Property type is big. You want a property that people desire to live in. I think more than anything, too, Matt, when we look at single family homes, if you're looking at single family homes or duplexes, and you're looking at, okay, should I buy this property? You think about those things. Is it in a desirable location in a good school district? And is it a desirable property for somebody to live in? If it's a property you're like, nobody wants to buy this property, but it would become a good rental, I think that's a terrible investment, right? Nobody wants to buy this and live in it, but it's okay rental. I'm going to buy it. No, that's a terrible investment, because then you can't sell it, right? But if you're like, this is a nice house, it's a 3-bedroom, 2-bath, or whatever it is, like, got a good layout, everything looks good neighborhood, good school district, perfect. That's a great house to buy.
Another disadvantage with the 1 to 4 units is property management. It's easy to trick yourself into thinking like, oh, I'll just save on property management by doing it myself, but then you're doing it yourself. But if you're hiring a third-party property manager, that's the most expensive kind of property to hire for, because then it's like 10% of gross often that you're paying for that versus like larger multifamily, it's much, much less.
Yeah. So that is definitely a big portion of why it's probably not nearly as attractive of an investment, right? It's easy to look at your pro forma and go, look at how much money I'm going to make on this thing, and forget how much it's going to cost you to maintain it. It's going to cost you to manage it. It's going to cost you to lease it. You know, the other thing is once a tenant moves out, it's 100% vacant. It's a duplex, it's 50% vacant. You're not making money during that month or two. So, big disadvantage. I think if you can get into single family and scale quickly, that helps because now the management becomes easier because it's more efficient because you've got more properties. You can start to hire people, or the third party property management's going to charge you less per building, right? And it's also, if I lose one tenant, yes, it still affects that house the same. It's still 0% occupied house. But if I've got 50 single family homes and I lose one tenant, I only lost, now I'm at 2%, right? So 2% vacancy. That helps if we're able to do that.
especially if they're located reasonably close to each other, because
The
then
closer, the
yeah,
better.
yeah.
Yeah. So you're seeing a lot of these developers build the rent communities. Now, I think that's like a hybrid, and that's, in my opinion, like the best of both worlds. So now we've got the single family homes, people that want to live there, they can stay a long time, they got nice green space, everything's taken care of for them. So that's a great scenario, right? And you've got it all centrally located, so we can hire a truly professional managers to manage the whole location, the whole site. We can have some amenities. We can get the best of both the apartments and the single families all in one, and we can have a community with 50, 100 homes for people to live in, whether they're townhouses or detached single family houses. So those are great communities for people to get into. But if you're just buying one-offs, the closer the better. You don't want to drive across town. You don't want to have your maintenance people drive across town. That just costs money.
Yep, exactly. And another thing with single, or a disadvantage for these small multifamily as well as the single family, is that when you're rehabbing the units, like each unit is unique, versus a large place. Like they're very, very similar. So your rehabbers, your contractors are kind of get things to a T if you're doing a full renovation, versus a single family. If you've got 10 single family houses, everyone is different, and then you have to like buy specific flooring, specific appliances, all that kind of stuff.
We, when I was doing a lot of single families, we tried to get it as kind of streamlined as possible. So we'd use the same light fixtures, same cabinets, same flooring as much as we could. But there's always differences, like you said. It's always, this house has hardwood floors already. This house doesn't. This house, the layout's like, a rambler, a 4-bedroom rambler, and this one's a 2-story whatever, Queen Elizabeth, it's like 4 square or whatever. I mean, every house is different, and so yeah, certainly you can't get it to be to where it's super efficient with the renovations, and getting people in and out of the properties more difficult as far as maintenance people and people to show it, and all that kind of stuff. So there's definitely more work on them, but there can be a lot of reward as well.
Mhm.
So I like them. I don't want to slam them. They're not maybe my favorite food group, but they're definitely a good one that I think is profitable if you do it right. I think that's the hardest part, Matt, is doing it right and truly managing them the right way, and being efficient with them. I think most people assume the profitability is going to be higher than what it is, and they miss on that because of the lack of efficiencies with the single family or small multifamily. And they might do well on one, but once they get 10, all of a sudden they realize that it's difficult, and they were making maybe 10 grand, 15 grand a year on the one, but now after they got 10, they're averaging only whatever, 5-6 grand a year, and they're wondering why, because of the lack of efficiency. That's just how it is.
Yeah, I think people are really surprised by that. They watch all these HGTV shows about, rehabbing, and fix and flipping and stuff. And they're like, oh, this is so easy. I could do this. It'll be fun. I'll do whatever in a weekend. And then they get to it and you're like, oh my gosh, this is so much work.
Yeah. Yeah. And the other thing too is the lending gets harder as you get bigger.
Mm-hmm.
So it's definitely harder to find loans. The first 5, probably easy. The second 5, the next easiest. After that, it gets really difficult.
Well, you do have the limit of, you can only have 10 loans in your personal name.
Personal name. Yeah.
Yeah. But like if you're married, 10 in yours, 10 in your spouse's.
Yeah, maybe.
Yeah, maybe. But if you can each separately qualify, but after that, it's portfolio loans.
Yeah, portfolio. I use a lot of local bank loans. All my properties are secured by local banks. And so that's my properties, my single families, my duplexes, they're all on 20 or 25-year amortizations, personally guaranteed. Usually I worked a sweet deal with a bank several years ago where we got I have almost my whole portfolio is now with them. 25-year amortization locked for 10 years. And it was a really good interest rate. I can't remember what it is now, but 4% or 3.5% or something like that. But your interest rate's always going to be a little bit higher when you're using those commercial loans. And then it's 25-year AM typically. So it's going to be a hit on your cash flow too. But of course, you're paying it off faster. So, but yeah, once you get so many, you got more hurdles to work through.
Indeed.
But never let hurdles stop you, right? Never let hurdles stop you. There's always a way around it. There's always a way to continue forward. But single family homes, man, I mean, I tell you, they can be a good food group to get into if you do it right, if you can scale properly, if you can put the right systems and process in place. It can still be a good food group to be in. And, don't be embarrassed to say you got a bunch of single family homes.
Yep. And it's a good way, a common way to get started, so that's perfectly fine to get your feet wet and then expand from there if you want to.
Yeah. Yeah, definitely. Cool. All right. So next week, Matt, we're going to hit on multifamily. Is that correct?
Yes.
So obviously that's what we talk about most on the podcast. We'll hit multifamily, but then as this goes, we're going to dive into other things. This is going to be a series. So we're going to dive into retail. We'll dive into office. We'll dive into industrial. We'll dive into self-storage, assisted living. So we're going to dig into some of these, and we might even go micro into even opportunities within. I don't have the whole series. Matt and I just started this, so we don't have the whole series, but we might dive into short-term rentals, Airbnbs, development. So we'll see how far we take this, but we're going to dive into kind of these asset classes, try to hit some pros and cons, and talk to you a little bit about, what's going on in the industry. But there's a lot of food groups out there, Matt, and there's a lot of opportunity for people to do well, to make money, and to really be a positive impact if they do it right.
Yep. And really, there's no right or wrong asset class. Like you just, explore the different options and choose which one you like the most and makes the most sense for you.
Yeah. People always ask me that, like, what should I get into? Is it multifamily? Is that the best for me? I'm like, I don't know. You tell me what the best for you is. Multifamily is just something I picked, but doesn't mean it's the best. I love it. I think it's great, but I also like a lot of other assets, and I think they're great too. I mean, industrial has been the freaking darling of real estate. Should I have done industrial versus multifamily? Not necessarily, but it's a great asset class. Is retail terrible or is office terrible? No. Some people are doing extremely well on it. The ones that are doing it right, they're taking advantage of the opportunity, right? Be fearful when people are greedy, be greedy when people are fearful. I mean, they're taking advantage of the fearful people right now. And so there's all these asset classes. They all have advantages and disadvantages. The key is that you got to dive into them, focus on them, make sure you got the right partners on whatever you're doing, and you'll do well.
Very good.
Cool. All right, man. Well, that's a wrap for me. Anything else?
Oh yeah, just one last thing. I want to remind people, April 26th, you're going to be having a lunch and learn event about raising $5 million in a day, and that'll be in Roseville.
Yeah. So it's going to be myself talking about, how we raised one of our last raises that we did. Not this current one that we're doing, but the last one, I guess in 2022, we raised $5 million in 24 hours. So we're going to be talking about kind of how we did that, the groundwork. Don't worry, it wasn't just all of a sudden magic. So we'll talk about how we got to that point, and then I'm also going to bring on a couple of investors of mine, and we're going to put them on the spot, and we're going to talk about what they look for in a deal, and just kind of some of the important things that as a passive investor you should be aware of. And this will be helpful for both if you're listening to this and you're like, hey, I'm kind of more of a passive investor, or if you're like, hey, I'm an active investor and I want to do some syndications, I want to raise some money. I think this will be a great lunch and learn for all those types.
Yep. Lunch is included, but tickets are limited. So buyers for $35 each at northstarunlimited.live.
Cool. Matt, appreciate it. You have a fantastic rest of the day. Make every day Saturday.
Thanks, you as well.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. But your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.